Hello, everybody, and welcome back to the Last Honest Realtor. I am your host, David Fleming. Thank you for joining me today. We are going to do something a little different. Now, last week, if you listened, I did a podcast on landlords and tenants and their battles, horror stories, if you will, and I thought a follow-up was essential. I wrote about it on my blog on Monday, basically talking about the problem that no one really wants to discuss, about the idea that every single time you say no to a tenant, it's some form of discrimination. And obviously enough to fill 3,000 words on a blog, which right now is up to 35 comments, and I think the podcast was about 50 minutes. But we're going to push that back to next week because there were a lot of announcements this week. A lot of announcements that have a tremendous impact on the real estate market, not just in Toronto, not just in Canada, but in the United States as well. So we're going to talk about economics. We are going to talk about inflation and interest rates and federal banks. So I don't want to say that it's not going to be an exciting podcast because, well, if you read the title and you're already listening, I'm pretty sure you're a nerd like me. And wait, hold on. You're a nerd unlike me. I don't know where I was going with that. No, seriously though, you're probably interested in real estate, but also the economy and how they intersect. And this week, we heard from the CMHC. Well, actually, according to the National Post, it was Chrystia Freeland who's allowing more 30-year mortgages. I'll come back to that. I think it was a typo in their headline. But that was a huge announcement. And then 2 days later, we heard that inflation is at 2%. And then 1 day later, the US Federal Reserve cut their interest rate for the first time since 2020. All of this happened in 1 week. And I said, you know what? I think another landlord and tenant podcast can wait. So here's what I want to talk about, guys. It's the road forward. And when I wrote my blog on Monday, my blog for Thursday, I said, reading the tea leaves of the mortgage market. Monday's blog was landlord and tenants. Thursday's, which if you're listening to this was yesterday, or before, of course, is about the mortgage market and reading the tea leaves. And what I personally believe, and I don't want this to sound salesy, but I'm going to say it, the market should be absolutely jumping, and it's not. So bears are going to say, well, it's overpriced and, you're wrong and real estate needs to drop by 98% in value. No, look, the market should be jumping. And it's not, and that's fine. And I recognize that the market is going to lag everything that's happening. But what I will say, and what I am telling clients that trust me and are close to me, is that you're buying now to get out ahead of what I think is going to be an absolutely insane spring of next year. So that sounds salesy, David. You're a real estate agent. You're cheerleading the market. Just work with me. Listen to today's podcast and tell me that I'm wrong. So the road forward, to me, has never been more confusing and it's never been more clear. It's clear to me because I know what's going to happen based on the stories we're going to talk about today. But it's confusing because, look, guys, I have 11 listings right now, and they're not getting a lot of showings. There's honesty, which is rare. A lot of people out there are cheerleading the market. I'm going to tell you, it is a bit sluggish. Now, the things we're going to talk about, right? The CMHC changes, inflation, interest rates, the market. We're going to start with the CMHC changes because a lot of fanfare happened this week when we heard, as I mentioned, the National Post headline. Listen to this headline. Freeland allowing more 30-year mortgages, higher values for insured mortgages. Is it Chrystia Freeland that's allowing that? Or is it the CMHC, the banks, the lenders? I don't know why they're a slightly right-leaning newspaper giving credit to Chrystia Freeland. So first, a history lesson. Just let me back up before we talk about those changes. I did a podcast early on about the history of the CMHC's changes, and I thought it was pretty cool, but it was early on, so it doesn't get a lot of listens. But I racked my brain to think of every single policy change from the inception of, my career. No, from about 2004 onwards, whether it's about minimum down payments or whether it's about qualification, whether it's CMHC insurance. And if you want to listen to that, I thought it was a great podcast, but I'll take a nugget from that today when I say that I remember a time when you could purchase with what we called 107% financing. You did not have any money down. In fact, a bank would give you money back. I sold a house for $1 million to a guy who ran a hedge fund. He put down zero. They gave him the $1 million mortgage, and then they gave him $70,000. So that eventually gave way to this idea like, hey, we should secure our banking system and people should actually have money. There became the reason for the minimum 5% down payment requirement. Not long after, hey, over $1 million, you should have to have 20% down. Now, these are all good changes, and these all happen in and around the time that the world economy collapsed in 2008, the financial crisis in the United States, and people looked at our banking system as a safe haven and have ever since. But think about the difference between buying for $999 with a 5% down payment, so effectively 50 grand. But the minute you go to $1 million, you have to have 200,000. We'll come back to that because that is why we have this announcement from the other day. So eventually, and this is a few years later, to try to tighten things up a bit and take a little risk out of the market, the CMHC said, hey, listen, 5% up to $1 million, we can't do this anymore. So we're going to have a sliding scale, 5% up to 500K and 10% from 500 to 999, meaning that effectively you go from buying at 999 from 5% to 7.5%. You have to trust me if you don't understand the math, but if you don't understand that math, then you're going to have trouble with the rest of it. It sounded kind of jerkish, but I don't think it's in any way unfair. So I want to talk about insured versus uninsured. An insured mortgage. And normally we hear insured, we think good. In this case, insured, well, it's good for the lender. It's good for the mortgage insurers. It's not good for the borrower. Insurance. If you have less than a 20% down payment, by law, you have to take out insurance. You pay for that through the CMHC. The insurance is to insure the big banks, to backstop the banks, which is great for them. Safest banking system in the world. Now that insurance is paid for every month, and it's a lot of money. If you were to look at what your mortgage insurance is, when you buy for $999 with 7.5% down, it might not sound like a lot at, $38 or $128 a month, but it's amortized over 25 years. And when you sell the place, by the way, you have to pay off the entire amount. So that aside, insured versus uninsured, an uninsured mortgage. Uninsured does not really inspire confidence, but uninsured is good. It means that you bought for $1 million and you had 20% down. So now we get into the announcement from a couple of days ago, and I'm going to read the article. Well, not the article. I'm going to read part of this from the National Post. Finance Minister Chrystia Freeland announced Monday, Canadians will be able to borrow for longer, while also increasing the maximum value for insured mortgages, potentially giving buyers more money in the housing market. I like that connection there. Freeland announced that starting December 15th, the cap for insured mortgages will rise to $1.5 million from the $1 million cap today. This would allow buyers to qualify for larger mortgages without putting 20% down. Seems to reason. On the same day, the government is also expanding the availability of 30-year mortgages. In the spring budget, the government expanded the eligibility of those long-term mortgages to new buyers who are purchasing new builds. Oh, we'll come back to that. But now the 30-year availability will apply to both new buyers and people buying new construction homes. Freeland said the changes will put more buying power into the hands of first-time homebuyers and give them an advantage. Here's her quote. We also spoke to a lot of economists. We spoke to a lot of housing specialists. Sorry, it's a politician, so I'm being patronizing. We spoke to a lot of people in the financial sector, and really what this is all about is putting the dream of homeownership in reach for younger Canadians, giving first-time homebuyers a leg up in the housing market, she said. It makes me want to puke. Segue here. There was a lady who lived in Leaside growing up, and she eventually went into politics. And at my grade 8 graduation, I was standing outside, and she came over and talked to my parents. And they said, thanks so much for writing Julie, my sister, a letter of recommendation for university. And she said, I was so happy to do that, and I will always do that for any member of the Fleming family. And she just went on with this gush. And I was standing there. I was 14. I didn't know anything. And my mom, with her teeth clenched, she turns to my dad. She goes, such a politician. And he said, careful now. I'll never forget that. Anyways, politicians, they're just like anybody else, right? I'm a real estate agent, so stones, glass houses. In any event, that was her quote. And she also said, Canada, can I do the voice? Canada needs to get more homes built faster. In order to get those homes built faster, more people need to be buying them. Oh my God, David, put an asterisk next to that because that's exactly the problem. She said the $1 million cap on insured mortgages was set in 2012 and the country's GDP has risen 65% since then, making it a dated measure. I think this is a really great question of recognizing economic reality, she said. It's so hard not to get cynical and say, okay, lady, liberal government, you want to recognize economic reality? How about driving the economy into the absolute toilet over the last 10 years, destroying the country, expanding the debt, giving away free money and free programs to everything when money's not free? Deep breath. But luckily, I'm not going to do that. So a couple things that I highlighted, and we'll start in reverse. Canada needs to get more homes built faster. In order to get those homes built faster, more people need to be buying them. Aha! That's the problem. That's how We build in Canada. We don't build unless someone buys it first, pre-construction. I've done podcasts on this. I've done blogs on this. And here's a politician who's actually the finance minister of the country who's admitting this, who's saying it like it's fact. In order for those homes to get built faster, more people need to be buying them. I guess if I were to try to defend her, I'd say she meant if there was more supply. No, I can't defend her. I know exactly what she's saying. We build when people buy. That's what we do. Now, if somebody were to tear down a bungalow up at Avenue in Lawrence on a 50-foot lot and build two 25-foot semis, sure, that person's buying on spec and they're selling it after the fact. Every single condo that's built is pre-sold. Almost every house that's built is pre-sold. And what she's saying, like it's fact, is exactly the gosh darn problem. Now, I'm going to move further up here. And she's talking about the dream of homeownership and reach for younger Canadians. Yeah, no, I get it. Every single Canadian should own a massive detached red brick Georgian Tudor in Rosedale. Guys, come on. Home ownership? Talk to me about home ownership rates in other world-class cities. I own my home, so tell me I'm biased. I sell real estate for a living. Tell me I'm biased. But until we acknowledge that there is nothing wrong with renting and that people all over the world do it, we're never going to, quote, solve the housing crisis. Now, another point I wanted to make, she referenced new builds. The government last year said they were extending 30-year amortizations for new builds. I'm going to put my tinfoil hat on. That means conspiracy theory. If the government needs to get housing built, it needs to be sold in advance. So if the government says we're going to make it easier to buy new builds, it's because that is the only way they can get housing built because they ain't building it. I would also argue, tinfoil hat, the government makes so much money off of new builds because of all the development charges. So tinfoil hat on, no kidding. Last year, the government said that they were going to extend amortizations to 30 years for new builds. That aside, the conclusion here, guys, is twofold. You can now buy up to $1.5 million with a 10% down payment. I think it's 5% of the first 500,000. So it's a sliding scale. I don't want to do the math. And secondly, you can increase your amortization as a first-time buyer from 25 to 30 for insured mortgages, which you couldn't before. So it's kind of funny because it feels like they're trying to help first-time buyers. And I'm reminded of another time they tried to help first-time buyers by introducing an ill-fated shared equity program. Do you remember this? The government decided to help first-time buyers. They will take people that aren't qualified to buy real estate and help them buy real estate. My God, the public policy in this country. Here's an article from March 1st, 2024 in the CBC. The first-time homebuyer incentive has been discontinued by the Canada Mortgage and Housing Corporation, the federal agency announced on Thursday. Launched in 2019, the plan was meant to help reduce monthly mortgage payments for first-time buyers by having the government take on partial ownership of a property. The government offered a loan of up to 10% of the purchase price that would go towards the larger down payment and thereby reduce the monthly payments. The program was hampered in part by eligibility issues, including limits to household income and the size of a mortgage the buyer could take on. The size of a mortgage, yeah, that's a really good point. So let's see, top down, there's Canada, that's our country. And then there are two major cities, Toronto and Vancouver, where, I don't know, let's say GTA and greater Vancouver area, I don't know, a third of the country, if you take Golden Horseshoe. And the average home price in and around these areas is over $1 million. What was the cap? What was the cap on this? Let me see here. Oh, $505,000. What an ingenious program for the government to roll out. Here comes cynicism. While probably hiring 10,000 new public sector employees and commissioning all kinds of studies and getting lots of charts and focus groups and such, how much money do you think they spent on that? Krista Friedland, didn't she say something? I think this is really a question of recognizing economic reality. Yeah, what was the economic reality of that failed program and all the jobs you created and all the Mont Blanc pens your employees probably bought? Jonathan's saying, move on. Okay, fine, I will. So I want to read you something else. Canadian Mortgage Trends, also March 1st. Since its inception, the program, we're talking about shared equity mortgages, has faced criticism and struggled participation rate below initial government estimates. Yeah, below by 95%. When it was unveiled, the government earmarked $1.25 billion over 3 years with the goal of assisting 100,000 homebuyers to purchase homes. As of March 2022, the CMHC received less than 16,000 applications. That's just applications. Those aren't people that bought. Critics argued that the maximum purchase price of $505,000 permitted under the program wouldn't do much to assist first-time buyers. No kidding. 5 months into the program, CMHC responded by raising the maximum purchase price to $722,000 for buyers in Toronto and Vancouver and Victoria. It's kind of funny because $505,000 wasn't enough in cities like Toronto and Victoria and Vancouver. So they raised it to an amount that still was not anywhere even close. I mean, yeah, sure, downtown condo, but we're always trying to help families, right? Buy houses. So we'll continue. After a review of federal housing plans in light of the current housing situation, the federal government decided that, ready for this, the first home savings account, I can't read today, is a better tool to help first-time homebuyers buy a home. It added that 500,000 Canadians have already opened the new registered savings account, which is designed to help first-time buyers save for a home. So if you open an account and put money in it, but the money that you put in is nowhere near enough to buy, and you can't put it in fast enough to chase the market as it goes up, what good is this account? 500,000 people open the account. Does this get a check mark? Yeah, good for the government. They're patting themselves on the back. So look, I think the bottom line here is that this was a terrible program and it failed as it should have. There is a quote here. It is from a mortgage agent. I am not at all surprised that this was canceled. The uptake was low, as was the cost of the client, far outweighing the benefit, especially with the rise in home prices in the last 5 years. So that program totally sucked. And the government, a week after, should I put my tinfoil hat back on? A week after the NDP pulled out of the deal with the Liberals, and there's all this talk about an election, a week after that, the Liberal government announces that they're going to help first-time homebuyers. Tinfoil hats on, guys. Conspiracy, timing, coincidence, I don't know. So should buyers be taking on a $1.35 million mortgage on a $1.5 million purchase? I sell real estate for a living. You would think that I would be like, yes, absolutely. But the question becomes, while we're helping first-time homebuyers, are we helping them take on risk? Are we making the banking system, the CMHC, the whole mortgage industry any less safe? Now you might say, well, it's only 10%. It's $150,000. But it's basically like this. You want to buy for $1.5 million. 3 weeks ago, you needed $300,000. Now you need $150,000. Can you afford the monthlies? So I'll give you an example. Years ago, I remember the clients, they were two young lawyers, and they said, look, we don't have a lot of savings. We got $50,000, but we make a lot of money. We just started. We can buy for $1 million and afford those payments easily, but we don't have the $200,000 down. We have 50. I found them the last house in Leslieville, last good 3-bed, 2-bath, etc., for $999, $999. I remember. We made 4 offers on houses for $999, $999. They got it. They bought it. They put 5% down. They can pay the monthlies. The monthlies aren't the problem. So I can argue this from both sides because telling young people to take on more debt isn't necessarily a good thing. The government has said, hey, everyone, today we're announcing help for first-time homebuyers. Oh, really? Are you lowering taxes? No. Are you spending less money on nonsense? And no, you're not doing that. Okay, you're helping first-time homebuyers to take on more debt. Thank you for that help. But in principle, I can tell you that, yeah, look, there are people out there that at $1.2 million, they don't have $240,000 down, but maybe they've got the 120. And maybe they just started a job in the last month to a year that pays them a ton of money. And they're like, $4,000 a month for my mortgage? No problem. No problem. I'm bringing in $18,000. I can do that. What I don't have is the savings necessary. By the time I save and maybe put it in this silly first-time home savings account nonsense, I'm going to be chasing the market. And yeah, the market's been volatile over the last couple of years. You're not necessarily chasing it. But if you look at a 20-year chart, it is basically a 45-degree angle from left to right. So guys, I'm going to do this. I'm going to take a quick break because I feel like I have barely got started. And yet I have talked so much. And of course, I made this political. That's so unlike me. Let me get my thoughts together because we're moving on to a couple other topics. And I want that to be incredibly succinct. Welcome back. And in the first section, we talked a lot about the big change from the CMHC that they're extending the $1 million mortgage cap for 20% down payments up to $1.5 million. Now, the second part of that, as I mentioned, was that they're extending the 25-year amortization to 30 years. Now, this is all about monthly payments. And let me use an analogy. When you buy a home, I often tell people you're buying a payment. Think about it. You could be concerned about the purchase price of the home. You could be concerned about the overall mortgage amount. What I tell people, and sometimes this might sound salesy, but you're buying a monthly payment. So irrespective of your interest rate, your mortgage amount, or your purchase amount, what are you paying per month? If you're paying $3,000, but you probably could safely afford $9,000, you're fine. You're good. That's what I tell people to focus on. And when I work with first-time buyers or when I work with move-up buyers, I say to them, look at what your monthly payment would be. So that's the preamble to explain why the change from a 25-year amortization to a 30-year amortization is important. Now, before the break, I mentioned that last year the government said that they would, for first-time home buyers, extend the 25-year amortization to 30 years when they purchase new builds. Before the break, I also put on my tinfoil hat and said this is probably because the government has a vested interest in new builds because that's the only way housing gets built. The government's made all kinds of promises to get housing built. And oh yeah, the development fees for new builds are massive. But the uncynical side, the positive side, the optimistic side, says that it's because your monthly payments are lower. So an example here, and I stole this from Jason Friesen, our in-house mortgage broker. Thank you, Jason. And he says, a longer amortization results in lower mortgage payments as illustrated below. He's given us an example, a 25-year fixed rate mortgage of 4.29% for a mortgage amount of $800,000. Your payment's $4,334.87 a month. But if you keep the same rate and simply change the amortization to 30 years, the payment drops from $4,334 to $3,936. So it's $400 a month, or about 10%. So whether you're looking on a relative basis as 10% or an absolute basis, $400 a month, it's about affordability. Now also consider that the longer the amortization period is, the more interest you're paying with every mortgage payment. I wish I had a whiteboard to describe it. Let me use a very basic example. Say your mortgage payment is $100 and $50 is principal and $50 is interest. Extend the amortization and now $40 is principal and $60 is interest. So we're talking about making it more affordable per month through lower payments, but keep in mind the proportion of interest is higher. So for some people, all that matters is cash flow. And I'll use myself as an example. So I bought a house and I took out the largest mortgage I could. This was in 2018 because the rate was 2.5%. So if you feel that, whether you're putting your money in Bitcoin or whether you're of the Warren Buffett or the Canadian pension plan, and you're like, if I could take a 7% compounded return every year for the rest of my life, I'd be fine. Look, it makes sense at 2.5%. Right? Why wouldn't you put your money out elsewhere? Now with rates higher, I'm looking and I'm saying, what's my monthly, right? In my household, with my cash flow situation, I'm just looking at how much money do we have? What does it cost for activities and groceries and kids and everything else? And then what do I have to pay my mortgage payment? So yeah, I don't care about the purchase price of my house. I don't care about the amount of mortgage. How much is that mortgage? Who cares? I care about the monthly. So I go back to the example I gave you before the break about the two lawyers. It's a perfect example. We have a great income and we can afford monthly payments, but we unfortunately can't afford the down payment. Or you have the people that have a massive down payment, but they're having trouble with the monthlies. So I don't say credit the government for this because I just can't say that. What I will say from a positive standpoint, while I fear that helping first-time buyers by allowing them to take out more debt could be problematic, I will say that they've addressed both situations. The situation of the first-time buyer that makes a great income and can afford the monthlies but doesn't have the down payment, well, guess what? We've extended that $1.5 million mortgage cap for 20% down. For the person that has the down payment but can't afford the monthlies, guess what? Per Jason Friesen's analysis here, a mortgage payment of, say, $4,300 goes down to $3,900 if you simply increase amortization from 25 years to 30. So the other thing that it does here, guys, is and this wasn't part of anything that you read in the media or from the government, it introduces first-time buyers to lower rates. So here's the rub. don't know why I'm taking my glasses off. I'm stretching. I'm getting ready. Okay, here's the rub. Insured mortgages get lower interest rates. Now that's counterproductive. Again, the word insured sounds positive. In this case, it means you have such a low down payment, you had to take out mortgage insurance. But there's usually a spread. So if somebody goes and buys a $2 million house with $1 million down, it's like they're penalized by the banks for having such a high down payment. Well, you can choose to look at it that way. But really what it is the bank is able to offer a better interest rate through that mortgage to a borrower with less down because it's insured and there's more safety. So again, from Jason Friesen, I'm going to read this. He says, for example, a 5-year fixed uninsured mortgage rate may be 479. Well, a 5-year fixed insured may be 429. In this case, he's got 50 basis points. So he says, for a typical 5-year mortgage, insured mortgage rates are around 50 basis points less than uninsured. That's crazy. That's so much. So now you're saying, okay, well, you're not saying, I'm going to say this because it's something I was thinking about at the break. I'd love to get out the calculator, the abacus, the spreadsheet, and look at if the lower interest rate offsets the CMHC payments. So think of the person that could buy with 20% down, but they're going to get a 5% rate. Now, if they bought with 10% down, well, they're going to get a 4.5% rate, but they have to pay CMHC fees. Maybe it's just a wash. In any event, I think we've spun our wheels with that announcement. The next thing I wanted to talk about, oh my God, are you ready for this? Inflation. So boring, right? Except I was in Tim Hortons this morning, which was lovely this time of year, getting my coffee, when something popped up on my phone, an alert. Toronto Maple Leafs draft Austin Matthews first overall. No, that was when I PVR'd the draft and I was like, how do I turn alerts off? They just kill the surprise. No, an alert popped up and it said inflation at 2% for August. And I thought, absolutely not. Absolutely not. We did a podcast not too long ago. And in that podcast, I said, and I think this was going back to, oh gosh, May we were at 2.9% inflation. June, we are at 2.7. And I said, if July is at 2.6, we're going to see interest rate cuts. And I said, if God forbid it was 2.5, and we shouldn't make a lot of a tenth, right? My joke was this isn't the Olympics. But if it was 2.5, my goodness, we're going to see rates cut. And guess what? It was 2.5. That was 0.2. We just saw 0.5. We just saw inflation go from 2.5% in July to 2% in August. And that is absolutely wild. So I've written on my blog that I've never experienced more conversations about interest rates and inflation as it pertains to real estate in the last couple of years. And yeah, maybe we're just more informed, or maybe the stakes have never been higher, because as far as our market goes and as far as the economy goes, interest rates and inflation, I would think, have probably never been more important since maybe what? Recessions in the 70s and 80s. So I'm going to read this. This is an article from today's newspaper. Inflation slowed to 2% in August, hitting the Bank of Canada's target and adding the case for more aggressive interest rate cuts. Guess what we're going to talk about after. The reading was the slowest increase in the Consumer Price Index since February of 2021. And economists say it increases the odds of a 50 basis point cut at the central bank's next meeting in October. Here's a quote from James Orlando, senior economist with Toronto Dominion Bank. Inflation continues to validate the need for the Bank of Canada to continue cutting its policy rate. Okay. He said, and I think I need to do that thing where you take your glasses off and then kind of fog them. If you're listening, you can't see what I'm doing. It's for effect, okay? We calculate that the current policy rate is still nearly 200 basis points above where it should be based on the current state of the economy. If this was a cartoon, it's that one where the eyes pop out of the head. Remember that? Yeah, they probably don't do that anymore. It probably scares children, although it might explain a lot about my childhood. So 200 basis points. Can I enunciate? Can I turn myself into that Roger Rabbit cartoon? Are you kidding me, 200 basis points? That's kind of a lot. Now, Stephen Brown, Deputy Chief North American Economist at Capital Economics, said the lower inflation rate in August was mainly driven by base effects, and he expects it will rise back to 2.5% in the fourth quarter. Oh no. But his quote, nonetheless, the details of the August release provide further evidence that the inflation battle is almost won. Well, that sucks, because my last podcast, I read someone's quote that said the battle was won. He continues, and will serve to increase speculation that the bank might soon cut by a larger 50 basis points. One more article I want to read, because this has some Tiff Macklem quotes. This is from CBC News. We get a little bit of the same. And it says, quote, our confidence that inflation will continue to move closer to the 2% target has increased over recent months, Bank of Canada Governor Tiff Macklem said. Last month's 2% rate marks the slowest pace of growth since February of 2021. The Bank of Canada's preferred core measures of inflation also ticked down a notch. Here's another quote, this one from Andrew Grantham, CIBC senior economist. Quote, inflation remains unthreatening, and the Bank of Canada should now focus on trying to stimulate the economy and halting the upward climb in the unemployment rate. God, that sounds like something I said in a podcast a couple weeks ago. But here we go. Roger Rabbit eyes popping out of head, or for effect, taking glasses off and pretending to clean them. Quote, we continue to forecast. I paused for effect. I'm still talking. A further 200 basis points of interest rate cuts between now and the middle of next year. Mic drop. It was my pen. 200 basis points. And so I'm not trying to oversell this. And if I had more time, guys, I would be honest and I would go back and look at how predictions have evolved throughout this year. But to say now, where our rate is sitting at 4.25%, that you're going to have, quote, 200 basis points of cuts between now and the middle of next year, 2025, is something that was absolutely unprecedented at the start of this year. So before I move on, I want to mention this. At the start of this year, it was, when will we get a cut? And on Toronto Realty blog, we had an interest rate prediction game. There were 3 questions. When will the first cut be? How much will the first cut be? And what will the cumulative total for the year be? Now, I think it's pretty clear that of I think it was 26 people that entered the contest, the winner is going to be, and this is so awkward, David Fleming. No, seriously, guys, you can read on Toronto Realty blog. No fix. I made 3 predictions, and I predicted, I wish I printed this, either 100 or 125 basis points of cuts. And it did not look like that was going to happen. For the longest time, everyone was saying it was 50 to 75. I got the first one right. It was June. I got the second one right. It was 25 points. And I think there was like 8 people that had those right. And then if it ended up at 75 points, it was going to be a 6-way tie. And we assumed it was going to be 75 points. But if it was 100 points, a blog reader named House Keys would win. And I predicted 125 points. So I'm going to win my own contest. And then I'll probably give the prize away to somebody else. Now, point is, whether it's on Toronto Realty blog or whether it's myself through that contest that we ran or whether it's through economists, when we got to the start of this year, it was people predicting 50 to 75 points. And I've done podcasts and blogs talking about how the predictions have been revised. And so as somebody that has a mortgage renewing on their principal residence November 1st and bought 2 investment properties this year, I have been living and breathing these predictions. Coming into the year, I said to my mortgage broker, when will we see a 3.49% 5-year fixed rate? He said, I don't know, never. I said, come on, man. And he said, maybe, you'll see 3.99 by summer or fall of 2025. And I thought about that. And I thought, how am I going to work with the investment properties? What am I going to do with my primary residence? And as the year has gone on, we have seen more rate cuts and more aggressive cuts, and all of these predictions are being revised. So I believe it was in March or April, in a blog, I took Jason from Outline Financial, I took their charts and their predictions, and the banks were basically predicting that by the end of this year, we'd be, somewhere around 4.25, right? Down from 5. And then by the end of next year, maybe we'd be 3.5. We're now talking about 2.25. And we're not talking about the end of next year. We're talking about the middle of next year. So again, this is the key lending rate. This is the overnight lending rate. This is not a mortgage rate. For that, we would have to do a bit of math. But I go back to my example of the 5-year fixed rate, which was always the holy grail. And for me, I said to my mortgage broker, I will eat, on a variable until I can get down to a 3.49, 3.59, 3.69. And honestly, it looks like that is going to happen as early as next spring. So guys, let me take another very quick break because our camera is overheating, and I'll be right back. Welcome back. And before the break, we were summing up the conversation, about inflation, where it was, where it's gone, and what the expectations are. Now, another thing happened today, actually. This is Wednesday, we're filming. The U.S. Federal Reserve made an announcement. Oh, yes, they did. The U.S. Federal Reserve cut their interest rate by 50 basis points. Now, this is from the USA Today. The Federal Reserve lowered its key interest rate by a hefty half percentage point Wednesday, moving ahead with its first rate cut in 4 years and cheering markets that expected an emphatic move amid a softening jobs picture. I guess I should check my stock portfolio? Yeah, that'll be good for that. With the slowing labor market posing a growing risk to the economic expansion, Fed officials opted for a bold approach to launch a projected flurry of rate cuts now that inflation is easing. Sounds familiar, right? Not that different from Canada. The Fed has gained greater confidence that inflation is moving sustainably toward 2% and judges that the risks to achieving its employment and inflation goals are roughly in balance, the Fed said in a statement after a 2-day meeting. The economic outlook is uncertain, and the Fed is attentive to both the risks of both sides of its dual mandate. So the Fed cut rates. So I'm looking at all this, and I realize we spent a lot of time at the onset talking about the CMHC's announcement. The CMHC announced that they are going to extend the $1 million mortgage cap for a 20% down payment up to 1.5. They're also going to allow 30-year mortgage amortizations for first-time buyers, thereby making it easier to buy a home for people that have a lower down payment or need lower monthly payments. Inflation in Canada is down to 2% from 2.5 only a month ago. We have talk of, remember when I said, right, Roger Rabbit, eyes popping out, 200 basis points in cuts between now and the middle of next year. Before the break, I was starting to talk about when are we going to see a 5-year fixed rate of 3.49, 3.69, 3.79, and how that was an absolute zero at the start of 2024, but now all of a sudden it's almost a certainty. And we're putting all this together, and the real estate market is slow. So here comes my conclusion, right? Here comes my potential to cheerlead the market. Here comes my potential to be biased. I bought 2 condos this year, and history might show that I was 6 to 9 months early. But what I'm seeing are a lot of signs that the market is going to jump. Now, right before I came to film this podcast, I emailed a client, and they're looking to move from a semi in Leslieville to, a house worth, say the semi's 1.718. They're looking for $3 million, Leaside Young Egg. And I mentioned, the market's slow out there. And I think that the market is lagging all the indicators, and we're going to see a huge bounce next year. He wrote back and said, would you say now is a buying opportunity then? I mean, he gets it. And so what am I supposed to say? Yes, now is a buying opportunity. I bought 2 condos this year because of the buying opportunity. So let me go over this one more time. We had an overnight lending rate of 5%. It's now down to 4.25. It's going to go down to 3.75 in October with a 50 basis point cut. That's going to translate to a 5-year fixed rate mortgage of probably 3.99 or 3.89. Yes, under 4%, which we thought might happen in 2025. And now it's going to be a reality in the fall of 2024. We have more affordability for first-time buyers who can spread their payments out further over 30 years rather than 25, and they can have a lower down payment. We have a Liberal government that is signifying they're trying to help first-time buyers. We have inflation that is down to 2%. Do you know where inflation was at the peak? 8.1%. That was June of 2022. And it's now down to 2%. It went down from 2.5 to 2 in a month. And yes, economists did point out it's seasonal, and they expect fourth quarter for it to go back up to 2.5%. But the inflation battle has been won. You have a Fed that has cut their rate by 50 points, which is helping the stock market, which is, of course, signifying more cuts are on the way, which is giving the Canadian version, the Bank of Canada, as opposed to the US Fed, all the more reason for them to cut the rate 50 basis points in October, and yet the market is slow. So it might sound like I'm complaining. Can't wait to read the YouTube comments, right? We have 11 listings right now, and they're slow. So it makes me wonder, where is everybody? And here's my theory. Safety. The client that messaged me and he said, so is now a buying opportunity. Those are smart people. And if I said, look, I think the $3 million house that you could get right now, maybe it's 3.3 next spring, 10%. Now the $1.8 million house that you own, or say it's 1.7, all things considered, if it's 10%, okay, it's $170,000 difference. It would make sense to buy now. But I don't think that house is going to go up as much. I think that we're so conditioned to lower priced properties going up at a higher rate that we almost forget when people are making that big jump, that 3 million, that 4 million, which to many people listening is like, I don't really care. There's more money and there's more at stake. And that's where people push higher and those prices go up more. So I think for folks like that, yes, it makes sense to jump in. But what about everybody else? And here's where I'm really struggling. So I've given this analogy before, but I'm going to do it again because it makes such perfect sense. Let's say that a product or service, a stock, a widget from business school is at $100. And I'm a visual thinker, so I'm going to draw this curve down. It goes to 90, then to 85, then to 80. Do you want to buy in? No. It goes to 75. It goes to 70. Do you want to buy in? You should. You could. Your fear of buying at 70 is that it's going to go to 65 or 60. So someone else buys at 70. And guess what? It does go to 65. And you're thinking, oh my God, thank God I didn't buy. But then it goes to 70, then 75, then 80, then 85, and you buy at 88. That's what 90% of people do, in my opinion. They do not buy on the way down because it's scary. They buy on the way back up after it is absolutely, positively clear you're on the way back up. My point here is that we're on the way back up. I don't know where the buyers are. It's crazy to me right now with everything sitting in front of me, with the CMHC changes, with the inflation numbers, with the interest rate cuts, out ahead of us, with the talk of 200 basis points being cut between now and the middle of next year. It doesn't make any sense why people would be waiting. That sounded salesish. Yeah, I can see. I always look at it from the perspective of the random YouTube viewer, commenter, hater, basement dweller. That's like, well, what else are you going to say? I mean, look, we're doing fine. We've got listings. We've got buyers. And this isn't a public service announcement, but I just don't understand. Catch a falling knife, right? That's what people call it. And I bought 2 condos. I bought one in February and I bought one in July, and timing the bottom of the market. And you know what? Maybe the one in February, could I have got it for less, the same thing in July? Yeah, maybe. I'll be honest. I'll say, yeah, I got a great deal on it. But the one in July, I mean, that was crazy. That was somebody that just, couldn't hold on to it, needed to get rid of it, wrote down a massive loss, and those people were out there. And so, look, I'm not here to, talk about the victories. Well, I wouldn't say victory yet, right? I'd say jury's out. I haven't even closed on the darn thing. But I put my money where my mouth is, and I went out and bought 2 condos. And as I said, I might be 6 to 9 months ahead of the market. But my goodness, what is happening this fall? All of this news is so positive for the market and for affordability, and it's slow out there. And you know what? I talked to a friend of mine who works in wealth management, has been there for a long time. I talked to a very seasoned real estate agent, and both of them laughed and said the same thing. The market and its participants always lag the data and the conditions. So although rates are falling, and although inflation's down, and although the US Fed has cut, and although more cuts are coming, people don't act in the moment. They want to see all of the headlines screaming about what a great opportunity is, talking about how hot the market is, which is so counterintuitive. You want to go and buy in a hot market? Yeah, most people do. That's when it feels nice. It feels so nice to bid on a house when there's 9 offers and win it. You all complain about the process, but when that house is on the market and you can negotiate on the price, you don't want to do it. It's so counterintuitive. So yeah, look, I mean, my conclusion here, guys, I guess, is that, as I said, people have never been so obsessed with inflation and interest rates, myself included. And, I joked on a blog post earlier this week when I said, I don't think any real estate agent had ever even considered interest rates until pre-pandemic or pandemic when the rates were cut, and how that impacts affordability and purchasing power, and how, of course, low interest rates help people to buy houses, and that drives prices up. But now we're absolutely obsessed with it. And I think prices are going to rise. I know that they're going to rise. There's a lot of inventory out there. Sales are sluggish. And maybe what happens is this. October 23rd, we get an interest rate announcement from the Bank of Canada. They cut the lending rate by 50 basis points. And that's when you start to see a sub 4% 5-year fixed mortgage. And maybe then we have 6 insane weeks in the market, but things are slow right now. We have a 550 condo, 2 condos at 699, a condo at 689. We got a house at 2349. We've got another condo at 889. I feel like I'm leaving somebody out. We got a townhouse at 774.9. I can't remember, but we've got across the board. We got 3.2 coming out in Yorkville next week. We've got a house for 1.895 coming out next week. We're across the board. And everything is just kind of flat. I mean, things are moving. But the offer dates, some work, some don't. You get into that new listing at 2,995, there's a lineup of people to get in. And you're like, oh my, this is it. This is it. It's happening. It's been a week sitting on the market. They haven't had any offers. Everybody is hurry up and wait. And I'm like, what are y'all waiting for? So say that's salesy. Maybe we'll come back to this next year and I can say I told you so. Or I can say I was wrong, but I don't think that's going to happen. How's that for a note to end on? Folks, thank you so much for listening. I thought this was necessary because of all of the news and the changes this week. One final thought that I didn't address, the mortgage stress test. Rates are plummeting. Why are we still qualifying people 2% higher? Save that for another day. If you're watching on YouTube, feel free to comment. Maybe I'll respond. Feel free to like. That would be great. If you're listening, wherever you get your music, on Apple or Spotify or something cool that I've never even heard of, which is a possibility, please feel free to subscribe. And if you ever have ideas for podcasts, I would love to hear from you. Folks, thank you so much for your support. Have a fantastic weekend, and we'll see you next time here on The Last Honest Realtor.